This is Dr. Econ with another report on the economy. I'm afraid to say it, but the Federal Reserve has really failed us this time. They have failed to rein in inflation. They started too late. They caused the inflation in the first place. And here are the consequences. As we go through this presentation, what I want to do is show you in what ways the economy has failed. In fact, the failure in the economy is that food inflation is not coming under control. Neither is energy, neither is services. And there are grave consequences for these things not getting under control again. The Federal Reserve has said inflation is only running at about 6.4%. Well, that's nice. I appreciate the fact that it was 11% and down to 6.4%. The problem is, it's down in areas that I really don't care about. Here we go. Let's look at food. Food is right now at 10.1% higher than last year. At one point in time, in August of this last year, in 2022, it was at 11.4%. And now it's down to 10.1. Hooey. That's not even enough to feel. 10% is enough to feel. All of us are going back and forth to the grocery store, wondering if we're going to be able to put enough food on the table to feed our families. So, one failure. Well, let's look at others. What about energy? Energy, well, we go fill up the car with less money than we did before. Yes, gas prices have moderated somewhat. But let's look at the rest of the energy sector. So here we go. It was at 41% higher than the previous year in June of this last year. And frankly, they show a dramatic decrease in the increase in energy prices. But let's look at all the components of the energy prices to see what the real story is here. Energy components, let's look at, gasoline, of course, which has decreased down to 1.5%. Okay, that's okay, I suppose. It's still quite a bit higher than it was 4 years ago. Now, fuel oil. Okay, we heat our homes with fuel oil, especially on the East Coast. It's 27.7% higher than last year. Energy prices in the area of electricity is almost 12% higher, where natural gas piped to houses is an average of 26.7% higher. So while I can appreciate the fact that going to and from work doesn't cost me quite as much, I still have to worry about the fuel bill during the winter times as I heat my home. And they are all upwards of over 10%. So let's look a little deeper into the services. During COVID, we had a lot of restrictions. We were told we had to stay in our homes. We had to social distance. If we wanted to fly anywhere, there were onerous restrictions on having to have the COVID shot or show that you had a negative COVID test before you went. So many people actually decided just not to fly rather than wear masks all the way during the flight and adhere to all of the challenges that they had during to get onto the flight itself. Well, flights are going better now. They're almost back to the levels that they were before. The challenge, though, is the price. So when we look at transportation services, because the services are all bunched into shelter, medical services, and transportation services. All of those put together are only 7.2%. But if we want to fly anywhere, if we want to take a train anywhere, if we want to take a bus anywhere, transportation services are right now running at 14.6%. This is a massive failure when it comes to the Federal Reserve. They can talk about the headline inflation being good, but when they talk about headline inflation, that doesn't even come close to the real inflation that we're suffering when we go to travel anywhere, when we go to heat our homes, or when we go to the grocery store to put food on the table. And so what are the consequences of this? Why would I be so concerned about getting inflation under control? Part of the challenge is twofold. Number one, I'm concerned about our government being able to pay its bills. And a significant part of its bills are the payment on the debt. And the second one, if any of you are investors in your 401k plan, your retirement funds, or any other types of investments, you're going to see a hit possibly with the stock market. We saw what the stock market did as it descended to a record level in 2022. Well, we might be in even for more of that. So let's look at bonds first. There are a couple things that affect bond prices. If interest rates, for example, are lower than the yield on bonds, instead of investing money by loaning it out to other people or banks loaning it out to prospective buyers of cars or mortgages, they'll buy bonds to, shore up their portfolio. So the incentive to buy bonds, if the interest rate is low, is to purchase bonds. Okay. Inflation, though, if inflation is being fought by the central bank raises interest rates in order to rein in inflation. Well, higher rates makes bonds less attractive. So in either case, if the Treasury wants to continue financing the U.S. debt, yield on the bonds must rise. So we're in a situation where either scenario puts the Treasury in a bind. If interest rates rise, the Treasury pays more to borrow. If inflation rises, the Treasury pays more to borrow. It's a lose-lose situation. In the possibility that interest rates on those bonds rise to a point where the debt level is higher than the amount of tax collections, then they're going to be financing interest on those bonds instead of just the amount of the bond face value of the bonds that are being cashed in. In that scenario, the government continues going further and further in debt without any hopes of recovery. So let's look at the other situation. If the central bank raises interest rates, higher interest rates make it hard for companies to continue borrowing and continue investing in their business. Therefore, they curtail both employment, they curtail both investments into more productivity and such. And because of that, their stock prices go down. When their stock prices go down, the stock market, of course, goes down along with it. If that starts happening too quickly, you have a situation where you have panic selling and the stock market crashes, similar to what it did in 1929. So you see the scenario unfolding here where all of these lead to pretty much the same consequence. Our investments go south, the government can't borrow, and the government, if it defaults, creates even more inflation. The Federal Reserve, because they've taken so long to get involved with handling inflation, the inflation rate was in the way above 2% from about March of 2021 all the way through the end of the year as it kept on rising. Finally, in February of 2022, they start actually doing something. And when they started doing something, it was already up over 8%. It continued to rise to over 9%. Well, the situation was already way overheated by the time that came. And because they did not take very strong, decisive action, in fact, now they're talking about even lowering interest rates, capitulating, putting more money into the market, and further exacerbating the problem instead of fully handling it. Because they're beginning to do that, we may see a situation where the government either defaults or we have the stock market crash, or any one of those situations that lead to serious economic harm. I hope it doesn't come to that, but Fed, start doing your job. Thank you for joining me. If you like what you hear here, please subscribe, and we'll keep putting out more videos and keeping you informed. Thanks for joining.